As we know, over the past 2 years, market's up what? How much is the market up? It's up about 50%, up 25% last year, up about 28% this year so far. Amazing 2 years in the indexes. So if you did ETF, DCA, meaning dollar cost averaging to any ETF, well, specifically not the small caps, but large caps, such as NASDAQ 100 or SPY, you're up 50% last 2 years. Now, you would expect most retail accounts to be up 50%. You will expect most retail accounts to keep pace with the indexes. Well, have they? Doesn't look like it. Why is that? Well, that's because a lot of people, a lot of retail tries to time the market. My mentors from 30 years ago, I remember every single little tidbit that they gave me, and then it's ingrained in my soul. Okay. One of the things one of them said was, Sergio, for the average investor, not us, not traders, but for the average investor, okay, time spent in the market is a lot more valuable than time spent trying to time the market. Well, it seems like a lot of retail tries to time the market. They try to buy the lows, they try to sell the highs. They get shaken out with what happened, let's say, in August, right, with the Japan carry trade debacle. Timing the market is very difficult. It's not for everyone. If you can do it, all power to you. You can beat the benchmarks. But the benchmarks have done so well, why even mess with it? Even if you time the market correctly, what is wrong with 25%, 25, 28% consecutive 2 years? There's nothing wrong with that. Well, there's a new study that came out, and that clearly shows the average retail investor is up just 9.8% year to date, while the S&P 500 is up 26.6%. They're lagging. They're way behind. And that's because, they want to get rich quick, and then they want to deal with options. And also during the August massive sell-off, we know what happened then, right? As many individual investors sold their best performing assets during the August pullback, including NVIDIA and Tesla. This is a big study done by JP Morgan, so I take their word for it. So this year's retail performance is the second weakest out of any year where the index recorded a positive return since 2015, people. So stop trying to time the market. Let the pros do that if they can. And even the best pros can't do that either. It can't beat the benchmarks. And that's why passive investing is in fashion. That's why everybody is pouring money into ETFs, because at some point you have to understand that, you may think you're good. You may think you're going to beat the benchmarks by 2 or 3 or 4x. Some people do, but very few, a handful, right? So retail investors are also on track for their fourth straight year of underperformance. So when there's this chart on the right, you guys can see there's black bars and there's blue bars. Okay, black bars is what the retail is doing, and blue bars is what the ETFs are doing, specifically S&P 500. Okay, look at 2015. Look at every year. Look at every single year. Okay, down years, up years. Okay, down years and up years. Retail is the black bar, by the way, right? On down years, retail is doing much, much worse than the indexes. Okay, as you guys can see here, right here, right here, and right here. Look at the size of this bar. On down years, the S&P 500 in 2022, as we know, was down 20%. Retail was down close to 60%, retail average account. And on up years, when everybody is trying to outpace the indexes, they're not doing well. Okay, they're kind of keeping pace with it. The only year that the retail has beaten the indexes was in 2020. And when was that? That's when the government printed 7 trillion, sent everybody money, and then everybody sat in front of their Robinhood accounts and flipped options and made money. But outside that, retail is completely lagging the indexes. And that comes from being what? A lot of people like gambling, and a lot of people think they are going to outgain the benchmarks. I mean, I try it, right? And then, in fact, at the end of this year, probably first week of the year, before I start trading again, I will share my final results, my actual account. I'll show it to you guys with full transparency. I had a good year. I'm not going to lie. I'm trying to keep my powder dry, although it's getting a little nerve-wracking today with what I'm doing with MicroStrategy, which I'll talk about shortly, and its ETFs. But look, that's the plan. I have a plan. I'm going to execute the plan, and I feel comfortable with it until I don't feel comfortable with it. But so retail is lagging. The retail cannot beat the benchmark. So please, please, just listen. Take my advice. Time spent in the market is a lot more valuable to you than time spent trying to time the market. Timing the market is very, very, very difficult. Over long periods of time, dollar cost averaging, steadily investing into an ETF, passive investing, is going to get you to the financial freedom that you deserve. It's not going to be anything else. It's not going to be swinging zero DTE options that I'm going to talk about shortly, which is creating massive problems for society, actually.